In this week's video, we'll show why stocks are vulnerable to more downside. We've got a lot to cover this week, so we'll move quickly. If you want to read these bullet points, you can pause your video player. We'll kick off with the market model, look at some cracks in the long-term view, subtle changes in the VIX. We'll examine gold's attempt at a bullish turn, revisit weekly probabilities and the recent Dow breakout, and talk about building bear market shelters. We often say that the charts say what they say until they don't say it anymore, which speaks to the need for maximum flexibility. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. This is a screenshot of the master CCM market model. This is described in a little bit more detail at the end of the video, so we'll move quickly here. The market model answers numerous questions, but the most important question is a reasonable exposure or mix between risk assets such as stocks and conservative assets such as bonds. As of Friday, March 7th, we were at a 90-10 split. A week later, we're at 57-43. How is it possible that the market model moved so sharply in 1 week? The answer lies in slowing momentum. The slope of the 50-day moving average here in the daily chart of the S&P 500 speaks to momentum. The steeper it is, the stronger the bullish momentum. When it flattens out, it's telling you that bullish momentum is very, very weak and in fact on par with bearish momentum. We're flat and rolling over again, telling us that all of our momentum indicators are in this state here where they could go from being bullish to bearish, and hence why the market model can drop so rapidly. That's a good thing because it is in line with a market here that is vulnerable to more downside due to the slowing momentum. We've made no progress in the last 11 weeks, slowing momentum, and we are now back in a box here that goes back 5 months, which speaks to slowing momentum. This flat slope here tells us to be open to upside or downside. Right now, the bias appears to be towards the downside until the market can prove otherwise. Now we're looking at a daily chart of the S&P 500. We have a violation of the fan principle where you break 3 trend lines. This trend line here was broken. This trend line here was broken, and this trend line here was broken. The fan principle tells us that when we break 3 trend lines, the probability of a trend change increases. We've got this flat 50-day moving average. As long as we stay above the 50-day or congregate around it, we need to keep an open mind about upside. How we break the 50-day or how we act around it will tell us something. A sharp break through a flat 50-day like this tells us more downside is probably in store. If we can congregate near the 50-day like this, it gives us a higher probability of rebounding. This is a weekly chart of the VIX. This is the S&P 500 here, shown for illustrative purposes only. For the most part, the VIX and the S&P 500 are negatively correlated, meaning when the VIX or fear rises, the S&P 500 tends to drop. You can see we had this downward sloping trend channel here that seemed to bound the VIX. When the VIX bounced at the bottom of the trend channel, the probability of bad things happening in the stock market increased. Bounced at the bottom of the channel, bad things happened. Bounced at the bottom of the channel, bad things happened. You can see now the trend in the VIX or fear was down as the stock market was going up. Recently, that trend has flattened out in the VIX, telling us that fear is starting to pick up. The subtle shift in the VIX can be seen more clearly here. Top of the trend channel, bottom of the trend channel, top of the trend channel, bottom of the trend channel. This is white space here, telling us again that something is changing here relative to this trend in the VIX. This change tells us to be more careful with our stocks. In fact, it appears as if the VIX is trying to make a bullish turn. We had a downward sloping trend channel, and now you can see more of a flat trend channel, again telling us something is changing. We've covered this long-term breakout of the NYSE composite several times. Just a quick update here. We closed below this breakout level of 10,301 this week. The NYA close on a weekly chart was 10,285, telling us again that the probability of bad things happening has increased. This line here, if we see further weakness, could act as support. Similar concepts here. Now we're looking at a monthly view of the NYSE composite. Your highest high, these aren't closing prices, here was 10,387. Once again, we're below that level and have not been able to sustain a breakout above this level. This appears to be acting as resistance. The longer we stay below it, the higher the probability that we'll see further corrective activity. Another point here. Here is a rally that occurred in 2005. ADX measures the strength of a trend. You can see when the green line comes back and hits the blue line, telling us that this uptrend is weakening. Here, after that point, the NYA moved from 86.50 at the high to a low of 77.08. That's a correction of greater than 10%. Once again, we have come back and hit this line. Can't emphasize enough, this is a monthly chart, so what matters is how it looks at the end of the month. But this too is telling us to be careful since we're at resistance here. The bulls would like to see a clear break above this level. If you have questions about the market model, chances are someone else has had a similar question. Hence, we have added a new resource to our website, Working with CCM. If you click on FAQ, you'll see a list of questions. You can click through to the answers. They tend to be about the market model, working with CCM, and our custodian, Schwab Institutional. Clients and regular viewers know what this chart is all about. We're looking at the S&P 500 weekly. One of the things that the market model tracks is weekly momentum. We know that when weekly momentum stays in overbought territory, the probability of good things happening in the stock market increases. Conversely, when we drop out of overbought territory on a closing basis on a weekly chart, the probability of bad things happening increases. Everything we do speaks to probabilities. You can see now we have dropped out, which increases the probability of bad things happening in the stock market. Everything that we just said about the weekly chart of the S&P 500 applies to the weekly chart of the NASDAQ, and momentum, it too has dropped out of overbought territory, increasing bearish probabilities. Newer CCM clients have a position in GDX or gold mining stocks that did very well last week. We're looking at adding gold to a broader base of portfolios. This is one of the charts that we're watching. This is a monthly chart of gold here. These are our moving averages. When blue is above red, the probability of good things happening in gold increases. When blue drops below red, the inverse is true. The probability of bad things happening increases. You can see here we get a bullish moving average crossover. Momentum comes out of oversold territory in 2008, which is a good entry point for gold. We have a similar setup now. We've come out of overbought territory, and we are trying to complete a bullish moving average crossover here. This is a monthly chart. It's only the middle of the month, so some patience is in order going forward. These are our weekly moving averages. We know that a bullish look is price above blue and red, blue above red, and the slopes are up. We have a mixed picture now with price below blue and red. The slopes are down. Those are a lot of no answers to our binary questions. We have not seen a bearish moving average crossover like this. If we do, the probability of corrective activity will increase. This is the daily breakout of the Dow that we've been watching. A few points. First of all, we're coming back and retesting the trend line for a second time, which tends to be a bad sign. We also have our 50-day moving average rolling over here, and price is now below it, raising yellow flags. If the support does not hold, this support is here. We may get a bounce. We also have momentum in oversold territory. Works the same way on a daily chart. The probability of bad things happening increases when you remain in oversold territory. The bulls would like to see this chart look more like this at the end of next week. We know at some point in the future that a bear market is coming. It does not appear that a bear market is imminent here. Some more things would probably have to happen, but just as a gentle reminder, this is the S&P 500 here in 2007 at 1576. It lost 58% in the bear market. Point of the exercise is we should consider putting a bear market game plan in place while the sun is still shining. If you have a simple game plan in place, I suggest you Google 5 reasons your simple bear market plans could backfire and see if your plan can pass the test. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currency, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shivako Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.